Debt to GDP ratio is up around 130%, going higher. And if you said, hey, look around the world, who's at that lunch table? Like who else has like 130% debt to GDP ratio? The answer is Lebanon, Greece, and Italy. That's your lunch table. This is the peer group that the United States is in, not counting Japan. Japan's in a world of its own, but they're much higher. But that's what the modern monetary theorists say. Hey, look at Japan. They're 300%. We could triple the debt and it's all good. That's not correct, but that is what they say, and Congress is acting that way. So with all that, budget deficits, trade deficits, high debt to GDP ratios, out of control spending, et cetera, why is the dollar strong? People are like, well, hey, people should be getting out of the dollar. It looks like the end of the world. Well, it's not. And here's why. Because there's a dollar shortage around the world. And people say, how can that be? The Fed printed, $7 trillion of money. And the answer is yes and no. Yes, they did print, over $7 trillion of base money, so-called M0. But that money didn't go anywhere. How does the Fed print money? Well, they buy bonds from dealers, from the big banks, the so-called primary dealers. So the open market desk at the Federal Reserve Bank of New York calls up Goldman Sachs, said, offer me 10-year notes. Goldman says, here's a price. Okay, done. Goldman delivers the notes to the Fed, and the Fed pays Goldman. And that money comes out of thin air. That is money printing. But then Goldman takes the money and gives it back to the Fed as excess reserves. It doesn't go into the real economy. Nobody borrows it, nobody spends it, nobody lends it. All that happens is at the Fed, you're building up both sides of the balance sheet. You're building up the asset side with U.S. Treasury securities, and you're building up the liability side with deposits from the primary dealers in the form of excess reserves. So that money doesn't do anything. I mean, it's printed, if you want to say that, but it has not caused inflation. The inflation comes from the supply side. The price of oil, supply chain disruptions, wheat, food, gasoline, et cetera. The inflation is flooding in, and it's exacerbated by fiscal policy. What I just described about the money printing, that's monetary policy, okay. But fiscal policy, which is the 5 or 6 or probably $7 trillion of deficit spending, that's helicopter money. When the federal government, the Congress, and the Treasury hand out checks, that's helicopter money. That's not like giving Goldman money and then Goldman gives it back to you. Forget that. It doesn't do anything. I mean, it exists. It doesn't do anything. But when the government hands out checks, that's real. Now, some people saved them during the pandemic. A lot of millennials opened accounts on Robinhood and started trading cryptos. Kiss that money goodbye. But more recently, that money has been spent, and particularly the Biden bill. I don't want to single out Biden, but we didn't need that in January or February 2021. And Larry Summers, to his credit, said so. He said, hey, we've had enough stimulus. We're growing. Let's not throw more money out of the helicopter. But they did. And that's when the inflation really took off. So that was driven not by monetary policy. It was driven by fiscal policy. But getting back to the strong dollar, the dollar generally does rally in a financial panic. And it does so because people want the best assets they can find. They're like, the best description I've ever heard of a financial panic is everybody wants his money back. It doesn't matter what you're in, get me out, sell it, whatever. I want dollars. Well, when you get the dollars, you got to go buy something. So you can leave it in the bank, but banks are risky. I mean, the problem in 2008 is the banks were failing. That didn't quite happen in 2020, but it absolutely happened in 2008. And the entire international monetary system is driven not by the Fed, but by Eurodollars, by money that banks lend to each other so that they can support their balance sheets and lend to customers or offer transactions to customers if they will. And the main transactions, the 800-pound gorilla, if you will, is approximately $1 quadrillion of derivatives, options, futures, forwards, swaps, swaptions, I could go on and on. By the way, for those who aren't familiar with the term, a quadrillion is 1,000 trillion. So we've got about 1 quadrillion or 1,000 trillion dollars in derivatives. All of that, almost all of it, has to be backed up by collateral. I could say, if I'm a hedge fund and you're Morgan Stanley and I call you up and say, Edison, I want a $5 billion total return equity swap, which is basically a derivative basket of stocks, and I can buy and sell stocks all day long, up to 5 billion, but it'll be notional. You'll pay me the profit or loss and dividends, but I don't actually own the stocks. I just have a $5 billion swap with you. And then you go out and maybe buy the stocks and hedge your position. Okay, you'll do that for me if I'm a big enough hedge fund or sovereign wealth fund or institution or whatever, but you want collateral. I don't have to give you $5 billion worth of collateral. I just have to give you enough, a little bit of foundation, and the mark-to-market losses. So if I lose money on that deal, I will give you that much collateral, until such time as we close it out, et cetera. So collateral is the key to the whole quadrillion-dollar structure I described. What can be collateral? Well, basically securities. But we're in a stage now where banks are, and hedge funds and others are becoming suspicious or nervous about each other's credit. These are the early signs of a global liquidity crisis, which is different than a recession and different than a called a plain vanilla, financial crisis. The liquidity crisis, is when you get ready to turn up the lights. So what's good collateral? Well, it used to be a lot of things, but today banks are saying to each other or to their clients, we don't want your corporates, we don't want your stupid mortgages, we don't even want treasury notes that are past like 2 years. We want 2-year treasury notes, maybe with a haircut, or 6-month bills, 4-week bills, 30-day bills, the best, absolute best, most liquid form of collateral. Well, okay. First of all, there's a scarcity of that. There's a collateral shortage, and banks desperate to prop up their balance sheets are asking, we're going to get some treasury bills, and they're bidding for them at prices that produce yields to maturity lower than what the Fed will give you for free. So if I'm a bank and I can call the Fed and the Fed will give me some treasury bills and I give them cash under an agreement to unwind that, and the interest rate on the cash is whatever, why would I go out in the market and bid on a treasury bill that pays me less than what the Fed will give me for a phone call? Why would you do that? The answer is you need the bill. In other words, you don't need an expanded balance sheet. You don't need more credit at the Fed. You need that bill to pledge as collateral on this quadrillion of derivatives. And that's what's happening. So how do I get a bill if I'm Deutsche Bank or Credit Suisse or UBS or UniCredit or Barclays or anybody else? I need dollars. Because the bills are denominated in dollars. So if I want to buy them, I got to get some dollars. So there's this huge bid for dollars that can be used to buy the treasury securities, to pledge as collateral, to prop up the balance sheet. And that's what's going on behind the curtain. That's the plumbing. That's why the dollar is strong, even though everything about the US economy is weak, meaning recession, long-term depression, deficits, trade deficits, political dysfunction, borderline civil war. It's all bad. But if I'm Deutsche Bank, I need those dollars to buy treasury bills to prop up my balance sheet. But if you can't get it, or you can't get it at a price, or the dollar gets too strong, et cetera, or the yields get negative, et cetera, what happens is, and this is happening, the banks are reducing their balance sheets. And it's just a matter of time, in my view, not guaranteed, but one could see a situation where suddenly some major player goes bankrupt. They can't meet a collateral call, or a bank gets in distress, or there's a run on the bank. Now we're back to 2008. This wouldn't look like 2020. This would look like 2008, except worse. We're not in a global financial panic right now. We may be heading for one. We talked about that separately. We're not in one right now. The US is definitely in a recession right now. We had 2 consecutive quarters of decline in GDP, first quarter, second quarter. Well, that's a recession. We'll see what the third quarter is going to be, but it may be prolonged. It may get worse. Europe is in a recession, based on the latest data. Japan is in a recession. China looks like they're in a recession. We're really looking at a global recession. Now, a recession, or even a depression, which it may turn into, is not the same as a financial panic. You can have panics without recessions. We saw that in 1998, 1987. You can have recessions without panics. We saw that in 1990 and 2020. Sometimes they do go together. 2008 was an example of both, a severe recession and a severe financial panic. Now, so here's the policy question. Does the Fed know what they're doing? The answer is always no. They never know what they're doing. They pretend they do. They say they do, but they don't really. Do they understand what I just said? Not really. So what are they going to do? They're going to keep raising rates because they got to crush inflation. Jay Powell does not want to be remembered as the new Arthur Burns or William McChesney Martin. He wants to be remembered as, if anything, the new Paul Volcker. And that's what Volcker did. Leave aside whether that was really the problem, but that's what he did. So Powell is going to keep raising rates, and they may raise them 75 basis points again in November, again in December, into 2023. And you're like, wait a second, Jim, you said we're in a recession and unemployment is going to start to go up, and there's demand destruction because of higher interest rates, and that may result in declines in housing prices. The inflation may cool off. So why is the Fed raising rates into weakness? And the answer is because they don't get it. They're always the last to know, and they're very political. Don't let anyone tell you the Fed's not political. So here we have the situation where the inflation is coming from the supply side. Fed can't do much about it. They can destroy demand, but that'll throw us into a recession. So why are you raising rates into what may be both a coming recession and a global liquidity crisis, which we just talked about? The answer is that's crazy. You shouldn't do it, but it's the Fed and they probably will.